Good day, ADK Wealth Advisory Group community and financial planning world. Dan Davis coming to you from our Franklin, Tennessee location. Purpose for today is, I would say 1.0 for Q2 summary. Why do I say 1.0? Earnings season ends reporting wise at the end of August. And there's a bunch of stuff going on that will cause me to do 2.0 after that's over with, so that we can really not just say, hey, June's over, but earnings have been reported as well. So if I were going to say what's going on with the economy, you know, it's one of those things where headline news versus data is so disjointed in that the data, whether you're using a dashboard like we use that does leading indicators and lagging indicators that will show risk of recession. I mean, when I look at that, there's 6 of each, so call it 12. 11 of them are green, yellow, red, just like a stoplight, and one's red. And the one that's red is sentiment. And so it doesn't shock me that one's red, because I mean, you can't really turn on the television or read any legitimate news that doesn't cause you to feel uneasy. So if I were going to put a bow on that piece of the discussion, it's that the economy, US-wise and globally, is doing a lot better than what it feels. And I think that's going to be a theme for a while, is that things are better than what they feel. When I take a look at the stock market, when you really look at just the first 6 months, there's a trend that's going on that we haven't seen in a while, and that's emerging markets is sort of leading the pack. And I'm always looking at not just stock market results, but what's going on with earnings. And when you look at forecasted earnings, emerging markets earnings look like they're going to be the leader of the pack for a while too, like more than 2 times what we're expecting from corporate in the US. So as a result of that, it's not a surprise that earlier in the year we started to rebuild the position in emerging markets, which we haven't had in years. And we're looking at increasing that again probably sometime, I would say in Q3. It's hard to say, is that a week from now? Is that a month from now? One of the funds we're looking at using focuses in on South Korea, and there's a bunch of stuff happening there where some deleveraging is happening. So the fund that we're wanting to use has been dropping quite a bit. So we're sort of evaluating that day to day, week to week, as to when do we feel like it's the right time to move into. And the other parts of the stock market is small cap has outperformed large cap. And that doesn't happen very often. And I've had a lot of clients ask me, are we going to enter into small cap? That's not a long-term trend I see. That's more what I think of as capital market rotation. I don't try to play through that, because you got to guess it right on both sides in order for it to work. And I think long-term large cap outperforms small cap. So we're not going to try to do the capital market rotation piece, but we are wanting to do what we think is going to be a longer-term trend with EM. Another thing that we haven't invested in a while is real estate. And we are seriously looking at REITs right now, publicly traded REITs. Again, what happens is we've got some dashboards that we're looking at, and that asset category return-wise is showing up in ways that are exceeding, say, the S&P 500 and some of the other indices. So when that happens, it captures my eye. It doesn't cause action, but it causes research. And so we're doing some research there. I'm not sure whether we're going to do a position there or not. If we do, it would probably come from money that's typically in bonds. And the reason why is the bond market's lagging. There's just so much uncertainty as to what happens with interest rates. I'll listen to some of the best economists, and you'll hear some of them talk that they think rates are going to go down, some that they think they're going to go up. I'm in the camp that believes that interest rates on the short end have already dropped by about 1%. When I take a look at yield on money markets, like one of the money markets we use, the JP Morgan money market that many of you have owned, the yield on it year over year is down 1%. So on the short end of the yield curve, it's getting pushed down. But on the long end of the yield curve, I don't think that's going to come down that much. And so as a result, I think bonds are going to get you kind of like what they call clipping coupons. With a lot of choppiness in it. So if we decrease bonds a little bit and go to REITs, it does increase the risk of the portfolio, but I think the risk-reward trade-off's worth it. More to come on that. no decision's been made. Very pleased with the way the portfolios are hanging up. I'm really surprised at the resilience of the global stock markets in the midst of a war with the U.S. and Iran. And candidly, that could escalate some more from where we sit, as long as we don't have a shock in oil where oil would exceed like 140 a barrel for an extended period of time. I don't think that the noise of the war really affects the U.S. as much as what the headlines would make you feel like it is. So if I were going to summarize all that in a short package, it would be favorable on stock market, very, very interested in what happens with earnings over this particular reporting season, because my biggest concern is the stuff that has done the best in our portfolios, which basically is tech, AI, semiconductors. 2022 was really hard on those assets. 23, 24, 25 year to date's been spectacular. So all those kind of runs do come to an end, and that end's typically very rough, meaning that you see the kind of pullback. What I'm not trying to do is anticipate when that's going to come, because that's a guess. We are monitoring earnings. So far, Amazon's reported, Alphabet's reported their earnings were really good, their revenue was really good, but CapEx spending was higher than what they thought, and they're in a negative cash flow because of all this spending on AI. And that spending on AI is driving a lot for our economy in a really good way. And so the concern I have is just, when does that earnings bust stop or close enough to where you have some kind of a market correction in that space? We're watching that diligently, because we've let those assets run that have done really well versus rebalancing, meaning taking a bunch of them out. Now, we've taken some profit, but it's minor compared to sort of a quote-unquote rebalance. And we're monitoring that literally daily, weekly type of stuff. It's just the investment committee has those conversations all the time. And really, I would say, spend less time watching the news, more time doing things that are healthy, like going out for a walk, exercising, things like that, because there's no way to feel good about what's happening when you're watching the news and all. You got to do enough, obviously, to keep yourself informed. But the news, whether it's written or whether it's coming on the television, is skewing what's really happening data-wise. And I'm now just talking the economy and corporate earnings and all that. I hear all these things about bubbles and all these things, and it's kind of ridiculous. So all in all, super satisfied with how the markets have held up, how we've performed. If there's anything you need, let us know. And 2.0 will come out sometime late August to tell you more about how earnings reporting came out and what that means. Have a great day. Signing off from Franklin, Tennessee. Enjoy the rest of your summer. Thank you.